Rolling a covered call. First of all, what is it? Well, it's a strategy where you buy back the call that you sold and then sell another call option, usually with a different expiration date. And in this video right now, over the next few minutes, we will discuss the why, when, and how. We will talk about why would you roll a covered call? When should you roll a covered call? We will also talk about how exactly do you roll a covered call, where we'll talk about just a straight rolling up and then also rolling up and out, rolling down and out. Then we'll also talk about, can you roll a covered call forever? Let's just very briefly recap the covered call strategy and what this is. I'm going to jump on the start chart here. So you see, a covered call is a strategy where you sell a call option against your existing stock position. And the idea is to collect extra options premium in addition to making money on the stock. So here is an example. I sold put options on Camping World with a strike price of $37.50. So here's the strike price of $37.50. And this is where on Friday, June 18th, right here, I got assigned. So I got assigned 2,700 shares of Camping World at a price of $30.50 per share. Now, this is where then on Monday, June 31st, I sold covered calls against my existing position. And this was right here. That was last week. And for every 100 shares that I own, I sold one call, and I sold each call for 50 cents. And since calls are trading in 100 packs, that is $50. So since I sold a total of 27 call options and I received $50 per call option, I made $1,350 in premium, and that's not bad for 4 days. Now, one of two things will happen. So on expiration date, which was on June 25th, right here, CWH number one will either trade below, let's start with below actually, we trade below 39. Well, what happens is, in this case, in the call options expire worthless, I keep the premium and I can sell more call options. Or door number two, CWH, Camping World, will trade above 39. In this case, my stocks that I own are getting called away at 39. I would make $1,350 in premium. And in addition, I'm making another $1.50 per share since I bought them for $37.50. times 2,700, that is $4,050. So my total profits on this trade would be $5,400. Not bad at all. It's pretty sweet profit. So why in the world would I mess with this trade? So why would I roll a covered trade? There's one main reason for rolling a covered call, and that's actually very simple. You should roll out your covered call when you have the opportunity to make more money by rolling than holding onto position. So let's just continue our example. I just want to go back to last Friday, and I want to show you a 5-minute chart of Camping World. And as you can see, Camping World was trading above the strike price of 39. So if I hadn't done anything last Friday, my stocks would have been called away and I would have made $5,400. Again, not bad at all. So why the heck did I decide to roll out my covered call position? Well, let's talk about this. I'm actually going here to a daily chart again, because this way it's a bit easier to illustrate what I'm doing. On Friday, the call option with the strike price of 39, let's talk about this week's, the July 2nd. So last week, the expiration was June 25th. This is the one that we want to roll, because this one, the June 25th, the July option was trading at $1.60. So, and at the same time, I could buy back the June 25th call for $1. Now, I sold this for 50 cents. So this means that I'm experiencing a loss. I'll lose 50 cents per option by closing out this trade, but I'm collecting $1.60 for next week's call. If we look at all this, the net actually is, let's go back here. So by rolling out, I'm actually making 60 cents per option. And since they're traded in 100 packs, so for my 27 options times $60, this is $1,620. Why would I do this? Again, if I would have done nothing, I would have made on this trade $5,400. Not bad. But by rolling the option, I can collect another $1,620 in options premium. And again, now there are two possible outcomes for this Friday, July 2nd. And the possible outcomes are, again, number one, CWH is trading below 39 on Friday's close. And so I just make the additional 1,620 in premium. I already collected 1,350 previously, so I would make $2,970 no matter what. However, if CWH is above 39, door number two, my stock gets called away, and since I bought them for $37.50, I will make an additional, we have just talked about it, $1.50 per share. So this would be an additional $4,050. So this means the total premium here, instead of just making $5,400, I can make $7,020. Okay, so this is what I can do by rolling out. In a nutshell, rolling this covered call will bring me an additional $1,620 in profits. And if we switch to my account right now that you see for CWH, which is the second row here right now, you see I'm already up $7,276. So instead of just taking the $5,400 and running, I'm now already up $7,200. So we got to talk about this. Rolling is very subjective because what's the downside? Well, the risk here is when rolling it, I'm now keeping the position longer. So the risk is that Camping World would actually drop below the price that I was assigned. So if Camping World over this week, by the end of the week, drops below $37.50, okay, then I would lose money on the stock. But you see, as long as I am somewhat bullish on the stock, and based on my three indicators here, I am bullish on the stock. So I can just keep rolling the call and collect more premium every single week. And this will then increase my overall profits on this trade week after week. So let's talk about it. How to roll a covered call. Rolling can be done at any time before or on expiration date. And for me personally, I usually only consider it on expiration day. And there are two ways on how to roll. Number one, you can do it manually. In this case, you first buy back the option that expires this week, and then you sell the option that expires next week. Or number two, and let me show this, you can let your broker do it. Because you see, many brokers, if you're looking at CWH here right now, they offer a roll option. So here I can, for example, roll expirations, and you can set a minimum price that you want to receive net after rolling. Now, in the example that I told you just a couple of minutes ago, it was 60 cents. And here you see, if right now I would roll it into next week, I would receive an additional 40 cents. So I can do this. So when you select the same strike price and just roll the expiration date, it is a so-called simple roll out. Now, in addition, you can also roll up and out. Sometimes it might make sense to roll up your call option, and let me just show you how to do this. So in our example, I could choose to roll up from the 39 strike price into the 40 strike price. Let's just plot it here. So what I would do is I would buy back the calls that expire this week, July 2nd, right? Because these are the ones that I currently have. So I would buy them back, and right now it would be probably for $1.70, right? And then at the same time, for next week, I am not doing the same strike price because we already talked about this. This is where I would get 40 cents. No, this is where right now, for this particular one, I'm going 2 strikes out to the 40 strike price. So in this case, I would have to pay 20 cents per option. So why would I do this? Why would this make sense that right now I'm paying 20 cents for this? Well, let's jump back on the charts. Here is what would happen if I'm rolling it out to next week. And again, this is where we are rolling out and we are rolling up to a strike price of 40. So I pay $20 per option, and I have 27 of those, so I pay $540. Or just to be honest, I'm giving back some of my premium that I've received earlier, because I told you that I received $1,350 in premium. So part of this I'm giving back. But if Camping World rallies above 40, I would make an additional dollar per share. So this would be an additional $2,700. So basically, I'm buying the possibility of making an additional $2,700 for $540. So in a nutshell, I make less money in options premium, but I collect more money if the stock price rises above 40. However, I want to be honest, rolling up and out, I don't think that I've ever done it. But what you could do is rolling down and out. Let's talk about this. If, for example, I'm no longer bullish on the stock, I could roll my call option down and out. So let me give you an example. So as previously, we are looking at the July 2nd that I have right now. So we're buying it back for approximately right now. You see the bid ask is $1.65 over $1.80. So it's probably, we would pay $1.70. Since I sold this particular one, so I sold it, as you can see here, for $1.61. So I would lose around 10 cents on this call, or $270. But I could sell the call option for next week, July 9th, and now I can actually roll it down from the 39 to the nearest strike price to 38.50. This is where you can see the bid ask is 240 over 255. So I would probably collect $2.50. So let's do the math here and see if this makes sense. So I'm giving up, so buy back July 2nd, and I'm losing $270, and then sell the 38.50 rolling down July 9th. And for this, I would get $2.50. So that's $27 times $250, and that is $6,750. That's not bad at all. Now, keep in mind with this, you're still making money on the stock. So the only downside, if CWH stays above 38.50, I only make $1 per share times 2,700. So this is an additional $2,700 because I bought the stock for 37.50 and I will be called away at 38.50 because that's right now my new strike price. And that's $1 per share or $2,700 for the whole trade. So total from the trade, if we bring this all up, if I would roll down. So let's do the math really quick here. And the math is that I receive $1,350, and this is from the initial call that I sold. Then I lose $270 from buying back the July 2nd call, and I receive plus $6,750 for the July 9th call. I also get $2,700 if CWH stays above 38.50 by Friday. So this is the gains on the stock, for a total of $10,530 for this trade. And this trade is only, what, 3 weeks, 2 weeks, 3 weeks. A 3-week trade for $10,530. Now that's not bad at all, right? And I know that we did the math super quick, but before we move on, so you can always rewind this. This is why it's a video that lives on YouTube forever. So if you need to run through the math, you can go back and pause the video. Anyhow, so if this is so amazing, this rolling stuff, can you roll a covered call forever? The short answer, yes, but you must have your bookkeeping under control to keep track. I mean, as you can see, whenever you roll a call, you might make, or like right here, lose money on the call that you're closing early. So make sure that you account for these losses, because otherwise you make much less than you think. Now, as you can see, rolling calls can be very beneficial if you know what you're doing. If you would like to know how I actually got paid, in addition to all of this, I got actually paid $1,350. This is in addition to all of this, for a total of almost $12,000. So if you would like to know how I get paid $1,350 to buy these shares at a discount, then click on the video that pops up right now and I'll explain it in detail in that video, because this is the wheel strategy and I want you to know about the wheel strategy. So take a look at the video right now. I'll also link to it in the description and I will see you in the next video.